on this edition of Next Africa. G20 finance ministers meet in Ballito, South Africa. While the threat of broad tariffs from the United States looms across the world's economies, the host nation hopes to forge consensus and help ease the burden of global turmoil on poorer countries. Plus, banking across the continent. How two of Africa's strongest banking brands are navigating global risks and corporate changes. And how Africa is being brought into the war between Russia and Ukraine. The program recruiting young women from the continent to build drones. Welcome to Next Africa. I'm Jennifer Zabasaja. The world's most powerful finance ministers and central bankers gathered here on the east coast of South Africa, encouraging cooperation and engagement as they tackle some of the world's greatest challenges facing the global economy. The setting, an idyllic Indian Ocean resort near the port city of Durban. But it's been anything but smooth sailing for host nation South Africa. For the second time this year, the United States top brass snubbed a G20 event, continuing a boycott of Pretoria. And the absence here of U.S. Treasury Secretary Scott Bessent has hung over the gathering, as well as an economic outlook clouded by tariff threats, as well as escalating geopolitical tensions.
We are, of course, meeting at a moment of ongoing uncertainty in the global economy, uneven growth trajectories, elevated debt levels, persistent inflationary pressures, and the complex implications of tightening financial conditions. The multilateral system is being tested, and our collective ability to respond will shape the pace of our recovery.
My hope is that we must have an agreement and emerge with a communique tomorrow. Which is something difficult over the years, starting from Indonesia. And I've been around since Indonesia. It has been a difficult period to get a communique. If we can achieve a communique where all of us agree on some of the areas of work, that to me would be a major achievement.
And I'm joined now by Bloomberg senior reporter for Africa, that's Anthony Squazine, here with us in Ballito. Anthony, thanks so much for being here. Listen, you know better than most people, South Africa came into this G20 presidency, number of ambitions and intentions, and then the Trump presidency came, and then tariffs came. What would you say will constitute a successful hosting for South Africa come the end of this year?
Well, I think if South Africa just gets some semblance of agreement, basically, we've seen the world's multilateral order under a bit of attack by this trade war, the Trump administration's comments on NATO, and all sorts of international institutions pulling of climate finance and international aid. So I think if South Africa can get as many of the members of the G20 to come together, reach some sort of consensus on what they can, especially if they can get the US to sign on to most of it, I think that will constitute a huge success for them in a very difficult year.
But climate finance, that's something the US has said they are not supportive of.
Yes, I think they're going to have to be very careful how they phrase sustainable finance and development finance in the various communiques and chairman's statements that they put out between now and the end of the year.
So let's talk about sort of what has been accomplished, because a lot of the discussion has been dominated by tariffs and the tariffs that are potentially coming on August 1st. Some people say they might be overshadowing a lot of the discussions that have actually been had. I spoke to Lesetja Kganyago, which is the South African Reserve Bank governor. This is what he had to say.
For all of us who are exporting to the country that imposes tariffs, there is an impact on output. The issue about tariffs also raises important issues. We are having to grapple with what would this mean for the outlook of the U.S. economy and the posture that the Fed might take in terms of monetary policy. It is not clear where we would end up, uncertainty abound.
Anthony, from your perspective, have there actually been achievements, or have tariffs been the headline throughout this year?
I do think a lot of these events have been overshadowed by the tariffs. However, what we're hearing from the various finance ministers we've spoken to, both South Africa's, Australia's treasurer, various other ministers here, is that they are trying to see through that and come to some sort of consensus and agreement, because they do feel there's a lot of volatility in the global markets, and the more they can show unity, the better it will be for all of them. So that's the expectation.
And so, Anthony, you've been covering South Africa and Southern Africa for quite a while now. How much does the country need a win out of this hosting, especially as the first African country to host the G20 summit?
Well, I think that's the point. Africa struggles to be taken seriously in a global economy. So this was a big opportunity for South Africa, and I think it's seen it as that. I think it's been unfortunate that it's come into the presidency at the time when there has been so much noise about tariffs and various other disruptions in global politics and markets. So I think it's making the best of a very difficult situation. I think what we will see now is whether President Cyril Ramaphosa of South Africa can persuade Donald Trump to attend in November. And I think if we can see South Africa hand over to the US, in some ways I think they'll be glad it's all over.
Physical handover.
Yeah.
We'll see. Anthony Squizine, always great to talk to you. Thanks so much for joining us.
And coming up, a changing of the guard at South Africa's biggest retail bank. We speak with the outgoing Capitec CEO who helped revolutionize the country's banking sector, plus his successor. Also, my interview with the man behind one of the most prominent banks in East Africa. For years, Kenya's economy has been seen as an area of relative stability in the region, encouraging the country to push for increased investment. As a result of these conditions, the country's biggest lender, Equity Bank, has been able to grow into one of the most influential financial players in East Africa. The bank's CEO, James Mwangi, recently shared his thoughts on the nation's recent political tensions and how potentially they could impact investment sentiment in the region.
So you can see the economy is still in good state when you compare that with the global GDP growth rate. Kenya is benefiting from the tailwinds of the East and Central Africa region being the fastest growing region, but it's not creating enough opportunities to match the students graduating from the universities. And that's why we feel the private sector could provide the impactors that will be required. There is need maybe to continue to improve the investment environment. There's an opportunity to look at incentives to the private sector for investment, and there is a room for focusing on consistency of policies.
Which leads me to Congo. There's obviously been a push to invest in Congo. We're seeing the U.S. Making an increased push to invest in DR Congo. Equity Group has quite a big presence there. When you talk about a consistency in policy, we're seeing some people express concern about policies in Congo as far as it pertains to Initiative 18. How do you feel about the policies, at least in Congo? Are they enough? Are they enabling enough to get investment, more investment into the country?
Of course, any policy environment could always be improved. But we entered DRC in 2015 when we bought a German bank, ProCredit. 2020, we doubled up by buying the oldest bank in DRC, BCDC, merged the two to create Equity BCDC. We now have 27% of the total market share. Our experience is that DRC has consistently been improving. We went to DRC when there were no capital markets, there was no treasury trading, but all these has been put. Innovation was low. We now have seen all the innovations that are in East Africa have now been approved in DRC. So you can see significant consistent improvement. But DRC is coming from a very low level in terms of policy framework. So the improvement has not put it at par with the rest of the East African community countries. But I trust that the decision by DRC to join the East African community will act as a catalyst and give impetus to the reforms because they need to be harmonized with those of the East African community.
Is it realistic to ask a bank like Equity Group to have different shareholders, or could that again lead other banks like Equity Group and others to move outside of a country like DRC and to not be harmonized, as you say, with the rest of the East African community?
Yeah, there was a policy proposal to diversify shareholding. But I think the way it was designed, it had slight challenges. We highlighted that. We did a memorandum to Parliament, and I'm glad that Parliament has now proposed the changes and passed the changes, and they're now headed to the Senate for the final approval. So, but that was just an exemption that is in that law in every country where listed companies that are publicly owned are exempted for further diversification because a group like Equity has 80,000 shareholders. So if you, 30,000 shareholders. So when you get the group to give 45% of the shareholding to 3 people, then you have got it all wrong. But that was a misnomer that is in the process of being corrected.
Which finally leads me to Equity Group potentially moving into the UAE, potentially a partner of the willing, as you say. Does this look like in the future this will continue to hopefully help the group grow and achieve some of those ambitions that you're setting out for?
No, we have seen the great example that has been set by Asia generally and Middle East over the last 30 years. The transition that has occurred in China, the transition that is occurring in India. And we felt that a strong linkage between Africa and Asia and Middle East would serve the continent in terms of market. Those economies have created the pools of capital. They build skills and entrepreneurship capabilities. And Africa, given the proximity to UAE, would benefit substantially if you could anchor trade there. We have also seen there become centers of trade in one way or another. So that helps Africa to diversify its markets from purely the traditional markets that were built at the old economic framework of trade and the World Trade Organization formulations.
Do we have a timeline for when that office is planning to open?
I'm so excited that it has been approved by the shareholders, and now we are going through the final phases of regulatory approvals. We needed the shareholders' approval before we could get regulatory approval, but they have been, our applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the 4th quarter.
And from one banking giant to another, there's been a changing of the guard at Capitec, South Africa's biggest bank by customers. Graham Lee has officially taken over as CEO, filling the shoes of Gerrie Fourie, who led the bank for the past 12 years and oversaw extraordinary growth for the institution. I recently had a rare opportunity to sit down with both of them at their sprawling Stellenbosch headquarters.
Capitec isn't your average bank. Neither are its founders, a group of wine-selling experts.
Let's call it 8 founders, 9 founders. Michiel, Rian, Carl, and myself was coming out of liquor. So we were going into the shebeens, into the townships, and understood that side of the market.
Shebeens are drinking spots in informal settlements, often inside a private home. Fourie's expertise in this informal retail sector has been key to Capitec's success. Shebeens and spaza shops in townships across South Africa have grown to become a parallel economy, demanding attention from the formal retail sector, something Fourie understood long before his competitors. While working for the Stellenbosch Farmers Winery in the 90s, he didn't just create the perfect wine distribution model. He also identified prime locations for just about any business serious about customers.
The plan was always retail, retail, retail. And it was we were obsessed with the word bank, because bank gives you trust.
Capitec's headquarters nods to that history, located among vineyards outside Stellenbosch. When Fourie and his co-founders started their retail microloan business in the 90s, few thought it would grow into South Africa's largest bank by customers.
You're seeing here now a very beautiful head office. Then we had nothing. We walked into a building that was empty. We had to bring in the chairs. We had to plug in the computers. We had to do everything. So we were really a startup company.
Much of Capitec's success is due to its relentless focus on banking the so-called unbanked. During apartheid, Black South Africans were excluded from formal banking. Even well into the 90s, lenders were slow to offer services to these people. Those living in informal settlements who, bank executives believed, had no interest in opening or maintaining a bank account.
If you look between the age of 18 and 60, 53% of South Africans has got a Capitec card in their wallets. We're still growing 150, 160,000 clients per month. For us, it's more now about, you've got 24 million and we're going to be at half year close to 25 million. But how do you optimize those clients?
Under Fourie, Capitec has been the Johannesburg Stock Exchange's best performing company since 1994, beating the next best three combined. Its market value exceeds that of Africa's #1 lender by assets, Standard Bank. While competitors have significant interests abroad, Capitec remains primarily focused on South Africa, where it's now branching out into all kinds of credit offerings, insurance, and a host of digital services. With a 30,000% stock growth behind him, Fourie decided to step down, news that saw the shares drop 4%. But the new CEO, Graham Lee, insists little will change. Having run the company's retail unit since 2022, he's promising continuity.
I think there's a lot of ways in which I'm very similar to Gary, in which we think quite similarly about strategies, about culture, about the importance of the various different groups of people within Capitec and how important that humanness is to achieving our goals in a world where it's becoming more and more digital with our competitors.
And it's not just Capitec. Many of its competitors have recently seen leadership changes. FirstRand, Nedbank, Investec, and now Absa all have new bosses. The sector has been on its toes as African banking faces continuing headwinds, challenges the new CEO says he's ready for.
There are global uncertainties, which certainly don't make the job any easier. Despite that, I do feel cautiously positive. And the reason for that, I think that in terms of our operations and our strategy, we are well positioned to thrive despite those challenges.
With Lee just taking over and an unprecedented stock gain to build on, investors will be watching closely on what he does to carry on Fourie's legacy.
Russian drones and African labor. We'll take a deep dive into how some of these workers have been tricked into becoming unknowing actors in war with Ukraine. But first, we'll leave you with our latest installment of Investing Africa. Lofty Capital's Idris Bello talks about solving for Africa's undercapitalization.
Africa's biggest asset, most strategic asset, is its people. And that's important to make that comment, especially in the light of recent rapprochement by some Western countries, which are focused on minerals, right? Congo and Rwanda and the rest. So the question then is, where do you find the capital? The first one is we need to utilize and to mobilize more local capital. In our pension funds across the continent, there's a lot of local capital that is tied down. And I must, acknowledge Ghana. Recently, Ghana has passed laws that allows a certain percentage of their pension funds to actually play in the venture, of their pension funds to play in the venture space. And we've been seeing this come up. My hope is that other countries on the continent are able to copy and emulate that, because that unlocks local capital. But we also can't play it alone. I think it's important to then attract other pools of capital. When you look at places like Egypt, when you look at West Africa like Nigeria, Ghana, every couple of years, 6-7 years, usually have a devaluation, right? And so the way we approach the market is that we see this not even as a bug anymore, it's a feature, right? That you then have to factor in. And what that does is it requires investors who understand those ecosystems, who are able to, one, hedge, and by hedging, not just your normal financial hedging, but in diversifying across the continent. So when you're investing in places not just like Nigeria, but also Francophone Africa, where the CFA is pegged to the franc, which offers you a diversification, but also across sectors, right? So you have some sectors that are actually able to earn non-local revenue, and that offers you a strategic edge against devaluation.
Young workers from Africa are becoming unwittingly involved in the war in Ukraine as Russia develops new recruitment tactics to help build weapons. Bloomberg's Toby Babalola has the story.
A Russian company that produces drones is attempting to fill staff vacancies by recruiting from as far afield as Africa. But its advertisements are not clear about the nature of the work.
Alabuga Work and Travel is a program that will help you realize yourself and all your opportunities.
With the glossy website and upbeat social media promotions, Alabuga Start targets young African women who are promised work-study programs in Russia's Tatarstan region. But the reality is different according to an investigation by independent think tank, the Institute for Science and International Security.
We've estimated that roughly 90% of the women who go to Alabuga end up in the drone program.
The recruitment program initially targeted poorer African nations, including Benin, Burkina Faso, Kenya, and Sierra Leone. This year, it expanded its focus to richer countries such as Botswana and South Africa, the continent's biggest economy, promising flights to Russia, cheap accommodation, and an opportunity to learn the language. International media reports suggest the reality of working in Alabuga is far grimmer than the version being sold.
When they get to Alabuga, they have a rude awakening in terms of what they were promised and what the work is that they're actually doing. And this is at its core extremely deceptive practices.
The Institute for Science and International Security says that the program manufactures Shahed 136 kamikaze drones, which have been deployed in Russia's war against Ukraine. The Global Initiative Against Transnational Crime warns that the recruits are being dragged into the front lines of the Russia-Ukraine conflict without their informed consent. Alabuga Start has not responded to requests for comment, but as the company expands into new countries, it brings into question the credibility of international safeguards to prevent these kinds of recruitment practices. For now, though, the recruits keep coming, and so do the drones.
And that's it for Next Africa this month. But don't forget to tune into our weekly podcast to find out more about what's happening across the continent. That is available on Apple, Spotify, and wherever you usually get your podcasts. You should also subscribe to our bi-weekly Next Africa newsletter, available on the terminal and website for even more reporting from the Bloomberg team. I'm Jennifer Zabasaja. Thanks as always for watching.